I am incredibly proud to bring to you a velocity banking calculator to help you pay off your auto loan faster. It does all of the mental gymnastics and math for you. I've got many videos trying to help you get out of debt. I've got multiple videos on paying off your car faster, and we have many calculators on the site helping you determine if you want to just add money every month or maybe make a one-time payment. But this is very unique, and it's something that we all talk about, but it's hard to figure out mathematically. So I'm going to show you on the whiteboard. Don't worry, there's no mental gymnastics. I'm just going to show you the results, and then I'm going to walk you through the calculator, and there's a link below directly to it so you can use it yourself. First off, velocity banking, what does it really do? It's helping you pay things off faster, saving time and saving money. And there's many ways to do it, whether it be a mortgage or credit cards, whether it be with certain types of loans. But in this case, we're talking about a car loan. And what it does to save you time and money is it attacks the interest, because you always have in each payment principal, meaning paying off the balance of the loan, and then interest. And the interest is calculated on the balance. The faster you can make the balance go down, the more interest you can save. That's it. Velocity banking in a nutshell, but there's many ways to apply it. So stay with me here on this example. This is a $40,000 car. And on the calculator, you're going to put in the price of your car. Let's say it was a 60-month loan. And you can tell it, well, I've already made 12 payments. So I'm on payment number 12 or 13. Because I know when we made the calculator, no one's going to be on day one of their loan. They'll be somewhere in the middle. They've already made some payments. So the calculator will still work for you. And let's say your loan happened to be about 7%. This is an average new car at the point of making this video loan, and that's an average new car price. And in 60 months seems to be a pretty popular term. Okay, what's the point of this? So you're going to have a payment, and you're just going to make it, and you're just going to keep going like usual. But now, what if you were able to obtain another loan? Not on the car. In other words, not using the car as collateral. Maybe it's a personal loan or something that your company allows you to get. And let's just say it's $5,000. And it's for 24 months. And it's 8%. The first thing you might say to yourself is, 8% is more than 7. Why in the world would I want to get a loan with a higher rate to pay off a loan with a lower rate? Well, apples to apples, that doesn't make sense. But when the terms are shorter, it often can make sense. So even though the rate's a little higher, the terms are a little shorter. Now, what this calculator does for you is it allows you to put in these terms. So you put in how much money, how long you're going to have to pay it off, and what's your percentage rate. And by the way, you can put in multiple loans. But in this example, $5,000, if you put it in on month 12. So you say, you know what? I've made 11 payments. I'm about to make my 12th payment, and I'm able to obtain this loan for $5,000, 24 months at 8%. What if I sent this in to the car company, that $5,000? Would that really benefit me? Because now I have to pay off this loan and pay off that loan. So I'm going to have my payment here is still the same, and I'm going to have a monthly payment here. But overall, will it benefit you? In this example, you will save just over $1,000. In other words, your total payments, if you paid off the car, would be X dollars. And if you use this additional loan, it's going to be Y, and Y is less. So you're going to pay $1,000 less. So you'll save $1,000. That's significant. And you'll save 8 months in total. So in total, instead of paying off your loan in 60 months, you're going to pay it off in 52 months, which is great. Now, and you tell it what month you're putting it on, and the results, when you hit calculate, it's going to show you how much money you're sending in every month to this loan, and it's going to show you this loan, how much you're sending in every month. And it does everything for you. Basically, it's going to say, well, by sending in $5,000, you're going to save, let's say, $1,200. But you're going to get $200 in interest on this new loan. You're going to pay $200 in interest. So the $1,200 savings is offset by the $200 of interest, and you save in total $1,000. As you can imagine, there are so many different scenarios. It depends on what month you're putting it in, how much money it is, how many months it may be for, what percentage rate, and by the way, you can put in multiple loans. You can then say, you know what, on month 36, I think I can get a $6,000 loan, but that might be 12%, but it's for only 12 months. Is that going to help me? And then you can click the button, add multiple ones. So bear with me, watch this instructional video, which shows you exactly how to use the calculator so that you can do the same math and find out if Velocity Banking will work with your car, and it will, depending upon the terms of those additional loans. Here we are starting at the calculator page. The link will be down below in the description. You can see we've got the calculators by topic. Scroll down, car loan calculators. We're talking about this one, the Velocity Banking with additional loans. I'm going to jump right in here. And on the board, as you saw, we had a $40,000 car. You put your loan amount. Interest rate on the loan, 7%. How long is the term? 60 months. We're going to say 60 months as if this loan just started. Now here is where you put in the additional payments, this section here. So this is the information you'll fill in. This is a summary over here on the right of the results. And at the bottom, it will have the loan schedule. I'll show you that in a second. So we're going to assume we're going to look at the whole 60 months. We're starting on month 1. And we say, well, what if we had a $5,000 loan, like a personal loan, whatever it may be? We're going to put it in on month 12. So on the 12th month, 12 months from now, we're able to get a $5,000 loan. The term, let's say it was 24 months, and the interest rate of 8%. Okay, now you can add another one. It says add another payment, meaning what if you got another loan down the road? But let's just use that and let's calculate. All right, as you saw on the board, if you look on the right here, what are we doing? We're trying to pay this off as fast as possible. And we're doing it by getting an additional loan. Notice this is 7%. Why would you want to get an 8% loan? That doesn't make any sense. Well, this is a shorter term and a shorter dollar amount. So let's see if it made sense. Well, total saved was $1,010.34. So you actually saved over $1,000 and 8 months. So instead of taking 60 months to pay it off, 60 minus 8, it would take you 52 months. Then it breaks it down for you. Your loan would normally have had this much in interest, $7,279. That means this loan over time, you would have that much in interest. But with this scenario, you are only going to pay this much in interest, right? So it's less. Then the explanation is it breaks it down so you can understand what's happening. By making lump sum payments, you save an additional over $1,000. That means this one lump sum of $5,000. Then here it says you actually saved $1,422 on this loan. Okay, but this loan has an interest rate. So you had $412 in interest on this loan. So you take the $1,400 saved here, you subtract the $400 in interest that you paid on this, and your total savings was $1,000. This does all of the mental gymnastics for you. So as you can see, if you were 12 months from now, you start your car loan, 12 months from now, you're able to get a personal loan for 24 months. You're going to start 12 months from now, 8%. So if we go down here, this is the initial loan schedule. Okay, so that's the amount of $40,000 what we put in. We said interest rate of 7, terms of 60 months. So this is your monthly payment. You can see that month 1, 2, 3, as you go down, you're making the same monthly payment every month. Then on month 12, you added $5,000. There it is. It's showing that you sent it in. And then after that, you continued making your payments. Well, what did that $5,000 do when it dropped in? It went immediately to principal, which means you dropped from 33 to 28. That's how you saved on interest. As you can see, for each row, this is 1 month. This is month 1. This is month 2, etc. Month 1, for example, of the $788, your principal paying down the balance is $561. Your interest is $226. The interest amount goes down, so you're paying less interest as time goes on because the balance comes down. Look at the drop here. When you added the $5,000, your drop in interest was fairly significant. It went to $190, but then look, $190 to $158. So whereas each one of these looks like it's dropping $3, $3, $3, $3, all of a sudden it dropped by $40, which means 40 more went to principal. That's where you ended up with the savings. Notice only 52 months, not 60, because you're done in 52 months.
So you save time and money. All right. So each month, this is exactly how much you're sending in for your payment. Now you have this additional loan, which started when? Well, we sent it in on the 12th. So on the 13th, we now have payments on this loan, $225.50 a month. So yes, you're going to have these payments for month 13 through 36 because that's 24 payments, that's 2 years. And the balance of this $5,000 goes down to zero. So what have you done here? This is velocity banking for paying off a car by getting an additional loan. And you can, just so you know, you can change all of these terms. You can change what month you're on. You can change the payments or how much you put down. In other words, what if you had done $10,000 and you calculate? Well, you're going to save 15 months, a year and 3 months, and you're going to save $1,700 because you saved, as you see down here, it explains every detail. You saved $2,500 in interest, but you paid $800 in interest on this one, so your total savings was $1,738. Now let's make it even more interesting. Let's say $5,000 paid off in 12 months. Let's calculate that. All right, we're at 1210 and we saved 8 months. But what if on month, let's say 28, so we paid this one off, it went from month 12 to month 24, let's just say month 30. Then after this one was paid off, 6 months after it was paid off, you came into another $5,000, but it cost you 10%. And you got that for 12 months. Let's calculate that. You're going to save a total of $1,500 in 15 months. So you can see here, as we go down to the schedule, this is what you're sending in. There's the $5,000 on month 12. Then would we say around month 30, we got another $5,000. See it right there? Took this to 45 months. Okay. Then here's our first loan. It was 12 months paid off from month 13 to 24. Then we got another $5,000 loan for 12 months from 31 to 42. Look at that. It shows you exactly how much you're sending in and which month you're sending it in. There you go. It's that simple. It is taking an incredibly complicated mathematical gymnastics, if you will, and making it easy. So if you're able to quite simply obtain, say, a personal loan or whatever it may be, and you drop that amount, it figures it all out for you and tells you how much you're going to save. A great way to pay off your car faster and save money by getting another loan, like a personal loan or whatever kind of loan you can get to pay this down, but put in the terms to make sure that it actually makes sense. I hope this has been helpful. Please check out all the calculators. Put a lot of time into these to make your life easier and help you get out of debt faster.
I hope this has been helpful. Please do hit that like button so it gets pushed out to more people. And please do subscribe so you see all of the videos on how to help you save money and preserve your wealth. Because I always say, the government doesn't care about you, banks don't care about you. Real freedom is financial freedom, and you alone are responsible for your financial freedom. Thanks for watching.